Bernie Madoff executed the largest Ponzi scheme in history. He defrauded thousands of Americans, stole tens of billions of dollars, and finally got what was coming to him: 150 years behind bars. As a seemingly respectable man, Madoff forged trust within the investor community. His goals were achievable, his strategy appeared legitimate, and he seemed like an all-around good guy. But behind closed doors, this Wall Street shark was swiping innocent people's hard-earned cash and dishing out nothing but lies in return. And he did so for over 17 years. Life in prison, a court-ordered fine of $170 billion, and a grisly reputation as a greedy Wall Street scumbag. That's Bernie Madoff's rap sheet, and this is his story. Born in Queens, New York, on April 29, 1938, Bernie wasn't slung into a family of astronomical wealth or typical Wall Street riches. His parents didn't drive top-of-the-line cars or live in sprawling mansions. Bernie's father merely ran a small sporting goods store, one which went out of business in the early 50s. Unfortunate? Yes. Devastating? Absolutely. But also, it was an inspirational catastrophe. After seeing his father's business transform into a sinking ship, Bernie Madoff was determined to achieve the lasting success his father hadn't. And in Bernie's own words, he was prepared to do whatever it took. But words and actions seldom line up. Any psychic who'd have predicted Bernie to uncover that long-lasting success by climbing the Wall Street ladder, scamming hopeful, trusting investors, and manipulating billions of dollars while holding the title of NASDAQ chairman for 3 years. Well, to call them crazy would have been a severe understatement. So, after briefly attending Brooklyn Law School, Bernie's career took a turn. He decided to venture down the investment banking route. In 1960, Bernard L. Madoff Investment Securities was born. With just $5,000 in clean capital that he saved from working as a lifeguard and installing sprinklers, capital meaning cash, and clean meaning not yet deceptively stolen, the 22-year-old Bernie took the first stage in his life in becoming a hotshot Wall Street personality. But the road to the top was long and full of hurdles. In the early 1960s, JFK's presidency had created a bear market. That put Bernie in hot water, and he was forced to take out a $50,000 loan from his father-in-law. A what market? When a bull hunts its prey, it thrusts its horns up into the air. A bear, on the other hand, swipes its claws down. Bull goes up, people get rich. Bear goes down, people get mad. And there you go. Who needs economics degrees, right? Okay, where were we? Lifeguarding, JFK, bears, yes, market maker. So while the heavy hitters on Wall Street were throwing around millions of dollars for breakfast, in the early 60s, Bernie was just a small fish in a big pond. His company wasn't even significant enough to be listed on the New York Stock Exchange. Without being on any of the major stock exchanges, it was difficult to compete with large banks and financial institutions. So how'd Bernie overcome this roadblock? He entered Wall Street as what's known as a market maker. Market makers help keep the market functioning by ensuring constant liquidity. Liquid market? Say what? Let's rewind and simplify. Think of the market maker like the middleman. If you want to buy eggs directly from a farmer, you'll usually get the best price. But if the farmer has no eggs left to sell, you're screwed. The market maker is always buying and selling eggs, and therefore always has a constant supply. Most market makers, like the large banks, only buy these metaphorical eggs in large quantities. Bernie, on the other hand, was happy to operate in smaller quantities, which meant he would be the go-to for penny stock traders. In his own words, "I was perfectly happy to take the crumbs." Blue chips are the big guys, the Apples, the Amazons, and so forth. Penny stocks are the little companies you've never heard of, that for all we know, are run by a computer geek from his parents' cobweb-filled basement. It's where the risk and reward are equally high. Trading penny stocks is how our other Wolf of Wall Street got rich. If you've seen the Scorsese movie, you'll know the Jordan Belfort story. If you haven't, here's the express version. At the helm of Stratton Oakmont, New York-based Jordan Belfort marketed worthless penny stocks to investors by flaunting his gift of the gab, while fueling his Quaalude-obsessed party lifestyle all the way through. Mom-and-pop investors would shell out their cash for a stock that Jordan raved about, say Charlie's Furniture Company, but they were unaware that Jordan had skin in the game. The price of Charlie's Furniture Company stock would go up, Jordan would sell his shares and make a good old profit. It was a classic scheme known as pump and dump. Pump up the hype, dump when it's worth most money. This was one of the biggest pump and dump schemes that the financial world had ever seen, one which led to investor losses of approximately $200 million. Jordan was ordered to pay back over $110 million in swindled cash from stock buyers, and ended up serving 4 years in prison, a charge far more lenient than Bernie Madoff would eventually receive. Let's circle back to Bernie then. How is it possible that he secured so much dirty money? The word? Trust. Because acting as a market maker, that middleman egg vendor, he was also operating a managed fund. In the world of investing, there are plenty of ways to get involved. However, unless the average Joe Schmo is willing to research constantly and regularly, then a common option is to enlist the services of a managed fund or a hedged fund. This is where you take your piggy bank over to the managed fund, say, "Howdy, here's my money, now make it grow," and in return, they take a percentage of your growth. With hundreds of different managed funds available, each has their own pros and cons. Ultimately, however, for you to choose a fund run by the likes of Bernie, you'd need to put your faith and trust in the management. So he's calling the shots and choosing where to allocate your money. You just sit back and relax. Well, hopefully relax. Bernie's company typically netted 10 to 20% per annum in profits. From the point of view of an investor, all signs lit up green. The returns were consistent, the investment was profitable, and the public portfolio, in other words, the companies he chose to invest in, were relatively safe blue-chip stocks. At least this is what it looked like on the outside. Unlock the door and peer inside, and it was another entirely different operation. How'd he get away with it? Trust. Profits. Well, the illusion of profits, and a killer reputation. With the help of Madoff's father-in-law spreading the word, who was a retired financial accountant with an extensive speed dial of contacts, Bernie's business grew and grew. Before too long, he'd amassed an impressive high-profitable client list, including celebrities such as Steven Spielberg, Kevin Bacon, Kira Sedgwick, and the New York Mets owner Fred Wilpon. By building a reputation as a wealth manager who attracted elite clientele, investors who gained access thought they had cracked into the inner circle of a tribe of exclusive moneymakers. He even turned some hopeful investors down, which just made them want a slice of his pie even more. Then there was an element of profits. By the late 1980s, Madoff Investment Securities was making annual returns exceeding 10%. A glowing reputation and consistent profits, why wouldn't you sign up? Well, we'll tell you why. Because in reality, it was nothing more than a classic Ponzi scheme. With Bernie at the helm, money that came in the door from new investors was being used to pay off promised returns to older investors. This made the operation seem profitable and legitimate. The older investors, who were now teeming with glee after making what they thought was a profit under Bernie's wing, were hungry for more, thus funneling more money into Bernie's scheme. In reality, no profit was being made. Money was just changing hands. All the while, the person calling the shots, Bernie Madoff, was subtly taking a piece for himself on the side. The money wasn't being invested. It was simply being put into a Chase Manhattan bank account. Why didn't the bank come forward? Because according to some estimates, they had made nearly $500 million from those deposits. If they were profiting significantly and had no specific reason to go digging, why would they raise any questions? A similar train of thought surrounded the investors. Even if Kevin Bacon suspected anything remotely shady, the reality of the situation was that Madoff was making money for him. If something's not broken, don't fix it. Bernie would eventually testify in court that his Ponzi operation started in 1991, in one of the 3 years that he held the coveted title of NASDAQ's chairman. However, Bernie's account manager, Frank DePascali, who had been working at the firm since 1975, decided that the fraud had been occurring for as long as I can remember. Authorities still aren't sure exactly when it started, but they know that by the time it all came crashing down, Bernie was playing hooky with over $64.8 billion in client assets. As the business expanded throughout the decades, Madoff began employing more family members to help with the company's growth. His younger brother, Peter, and his niece, Shauna, were heavily involved in the day-to-day operations, while his 2 sons, Mark and Andrew, worked in the company's stock trading division. No bond is thicker than family. Or so Bernie thought. He was forced to hide his secret from his sons for decades, but by 2009, his reliance on his nearest and dearest would come back to bite him. According to his statement, the Ponzi scheme lasted at least 17 years, almost 2 decades. How could Bernie Madoff continually rob innocent mom-and-pop investors of billions of dollars? With a glowing reputation and a respected persona, it's easy to manipulate the financial system when you've got an inside man, and Bernie was his own inside man. He sat on the board of the National Association Association of Security Dealers, helped launch the NASDAQ stock market, and acted as an advisor to the SEC on trading securities. Why would authorities expect someone right under their nose? So long as he continued to keep his operations under wraps from his high-profile colleagues, they'd rarely bark up his tree. Around the turn of the century, it all started to slowly crumble. In 1999, a financial analyst named Harry Markopoulos had informed the SEC that he believed Madoff was up to something. Based on his calculations, it was legally and mathematically impossible to achieve the gains Madoff was claiming, especially in times where the overall market was declining. The biggest red flag of all, according to Markopoulos, was that Madoff Securities was earning undisclosed commissions. Standard hedge funds took a fee of around 1%, so this was certainly out of the ordinary. But the SEC dismissed and ignored these claims. In their eyes, Madoff's lie was too large to be plausible. Their investigatory letters didn't make it past the draft stage. In total, Madoff Securities was partially investigated at least 8 times over a 16-year period, with complaints going back to as early as 1991. In hindsight, many feel that Madoff's worst damages could have been avoided if the SEC had put in a little more effort. Then came 2008, the year that would destroy $16.4 trillion of American net worth and wipe out over $2 trillion worth of Americans' retirement savings. The global financial crisis. As stock markets began to plummet, investors tried to withdraw $7 billion from Madoff's firm. Cash under the mattress seemed safest, but knowing how Bernie's fund operated, there was limited money to give. This would turn out to be the straw that broke the camel's back. On December 11, 2008, Bernie told his 2 sons that he needed to give out millions of dollars in bonuses much earlier than scheduled, a request that raised concern and suspicion. The conversation concluded with Bernie admitting that a branch of his firm was nothing more than a wild Ponzi operation. His sons reported him to federal authorities the following day, and the arrest was swift. By this point, the damage had already been done. $170 billion had moved through the principal Madoff account over its operating decades, with $50 billion of his investors' money down the drain. Gone, just like that. On March 12, 2009, Bernie Madoff pleaded guilty to securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering, false statements, perjury, false filings, and theft from an employee benefit plan. 11 charges in all. For his ongoing fraud, enormous breach of trust, and guilty plea on all charges, Bernie was sentenced to 150 years in prison and forced to forfeit $170 billion. Meanwhile, over 16,500 investors have filed legal claims against Madoff for financial wrongdoings. Almost a decade after being put behind bars, his requests for compassionate leave due to health complications have been denied. According to his lawyers, Bernie's only remaining hope is that President Trump commute his sentence. Alan Stanford's Ponzi scheme stole $8 billion from investors, and Tom Petters cheated innocent civilians out of nearly $4 billion. Not to mention Jordan Belfort. But none of their actions even came close to the blatant thievery at the hands of Bernie Madoff. The SEC was ridiculed for their lack of awareness, a surefire sign that we're unlikely to see something of this scale ever happen again. With increased scrutiny and advanced security technology, agencies will be on the lookout round the clock. Surely nobody in their right mind would risk 150 years in prison again. But hey, people do a lot of crazy things for money.